Go ahead and jump ourselves in to the chapter 10 slides. And we're talking about long-term liabilities here, but I've put, bonds on here, and that we're primarily going to be talking about how a company will handle the bond payable, which is a long-term liability. Remember, long-term liabilities are those that are going to extend probably past 1 year, and most of the time with bonds, for most of the questions, et cetera, that we're going to be looking at, the bonds are going to be 5, 10 years. Okay. Now, why does a company issue a bond? Well, they probably need some sort of financing for some sort of project. The project is probably going to be a longer term project, like building, construction of a building or something like that. And so they're going to need the funding for that. And so they will go ahead and try to match the funding with the length of the project. Okay, so if the project is going to be a longer term project, we'd probably issue bonds. Okay, now some key things that we need to understand about bonds, or key terms here. Most of the bonds that we'll look at in this class are going to be term bonds. Term bonds have a fixed term, a fixed period of time until they become due. Okay, so if we have a 5-year bond, it's going to mature, it'll be due, the company will have to pay that back in 5 years, and the term of that bond is what? 5 years. Okay, if it's 10 years that they'll have to pay that back, the term of that bond is 10 years, and at the end of that term, we pay back the entire amount of the face of the bond. So if it was $1 million worth of bonds, we'd have to pay back the entire $1 million. Now, sometimes an entity can use serial bonds. Serial bonds basically will mature in installments. So instead of having to come up with $1 million at the end of 10 years, the company will pay that off a little bit at a time, $100,000 in year 1, year 2, all the way through to year 10. We're going to study term bonds in here. Serial bonds come up much more when you're talking about governments. State and local governments tend to issue serial bonds, and they mature in installments, and it saves them having to come up with just one big chunk of money at the end of the bond. Okay. Now, we also have a couple of different terms here: convertible bonds and callable bonds. Convertible bonds, the holder of that bond can always take that bond and turn it in and get stock in exchange. So they call it a convertible bond because they can convert the bond to stock. And sometimes people like to get these convertible bonds, so they always have the option to trade that in for some sort of stock. Callable bonds are callable at the option of the issuer of the bond, the company that's issuing that bond. So at some point in time, the company can say, hey, even though the bond doesn't mature for another, say, 5 years, I'm calling the bond today. And you would have to give that bond back to the issuer, and then they would give you whatever the call price is, usually a little bit more than the face value of the bond. Now, why would a company call the bond? What would cause them to want to call the bond? Probably they issued that bond at a, I don't know, 10% interest rate, let's just say. Meanwhile, what's happened? Market rate of interest has dropped, and they figure, hey, we can issue some new bonds at a lower interest rate, so let's call those high interest rate bonds, and then we'll go ahead and maybe issue some new bonds at a lower interest rate. Those are called callable bonds. They're callable at the option of the issuer. Okay. Now we go through and we talk about the issuing procedures. And what's going to happen is we're going to see that there's going to be a face amount of the bond, and that will be an amount that will be paid off when the bond is maturing. And then throughout the life of the bond, there'll be periodic interest payments at and we call it a contract or stated amount of interest on the face of the bond. And we're going to see that that's called contract rate usually, could also be called stated rate, could also be called the coupon rate, and I'm going to show you an example where I think they've called it the coupon rate, but any of these terms are synonymous. Okay, and the interest payments in most of the examples we're going to be looking at are going to be made semi annually. Okay, so just to visualize here what's going on with these bonds, I am a company and I need some money, right? So I'm going to do what? I'm the company over here, and I want some money to build a building or whatever. So what am I going to do? I'm going to issue, this little guy over here is the bondholder. Okay, so what am I going to do? I'm going to issue him the bond. Okay, and what is that person going to give me in exchange for that bond? The person is going to do what? Going to give the company some cash, right? Going to give the company some cash. So now the company has cash and they can go build their building or put together their equipment, whatever it is that they needed that money for, right? Now, is this guy going to keep smiling for very long if I don't pay him back his cash? At some point, he's going to say, hey, where's my money, right? Okay. And so what happens? At some point, the company will return that money back to the bondholder, right? Now, what happens? Is the bondholder happy just to give his money to this company and then sit there and just get the same amount back? They're going to sit there and they're going to have an expectation that what? There will be interest payments that will be made, and typically these interest payments are made twice a year, every 6 months. And so they'll get that interest payment every 6 months for the next 5 years. If it's every 6 months for the next 5 years, how many interest payments are we going to get? 10 interest payments, right? Okay, so it's basically an investment for this bondholder who is what? Who is giving up their money now for the benefit in the future of getting the interest payments and, of course, eventually getting their principal back at the end, right? Okay, we are doing the accounting for the company here. We are doing the accounting. Isn't this a liability? Is this a bill? You're going to have to pay this back eventually, so it's a liability, isn't it? Okay, that's who we're doing the accounting for. We're doing the accounting for the company in this chapter. We are not worrying about the investor at this point. We're just worrying about who? The company that is issuing the bond, right? We call that company the issuer. And if it's a callable bond, they don't even have to wait for the 5 years. They can call that bond what? Anytime they want, if the if the interest rates start to kind of come down and they're saying, hey, I don't want those high interest bonds anymore, they'd probably call those, right? Okay, otherwise they're going to wait until the maturity date. Okay, all right, so a couple of things that we're going to look at. One, we're going to look at what should somebody be willing to pay for this bond. And then we're going to get into, and where we're really going to focus our midterm, our final exam questions and stuff, is on the accounting for the payments of what? This principal and interest. But let's just understand a little bit about how these bonds look and what they will, what some of the key terms are. Okay, so we have what? We have the maturity date of the bond. That is the date that the bond will mature. That is the day that the company is going to have to pay back the principal to the bondholder. Okay, we will have a contract interest rate, and they're calling that the contract interest rate. I'm telling you now that the longer you stay around in accounting, the longer you'll see that called other things, such as the stated interest rate. I've also seen it called the coupon rate. Okay, all of these are synonymous terms. Most of the questions I see now in our text call it the contract interest rate. But that interest rate does not change. It stays the same regardless of what happens with the market rate of interest. Once we issue those bonds, that stays the same. This bond must have been, this specimen that they gave us must have been what? Issued a long, long time ago for the interest rate to be, 11.875%. That's a pretty high interest rate, isn't it? Okay. And so this must be a pretty long bond. Was it like maybe 20 years or something? I can't see the term of this bond, but somewhere on here we would be able to determine the term on it, but it's due May 1st, 2017, right? Okay. Hi, guys. So then what? Then we have the face of the bond or the par value. This is the amount that we will pay the person back at the end of the bond. Okay, that's the amount that we pay when it matures. Okay, so we've got some key terms here, and let's just go ahead and let's take a look at this an example here where we're going to determine the market value of the bonds, which is the price that somebody is willing to pay for that bond. Okay, and it's going to depend on the dollar amounts that will be received, both interest and principal, the length of time involved, 5 years, 10 years, whatever it is, and the market rate of interest is used to calculate the market price of that bond, what someone is willing to pay when we issue the bond. Okay, so we come over and we take a look at this chart to determine whether or not the bond will issue for more than face or less than face. So is it going to issue for that $5,000, which we said was the face amount, or is it going to issue for an amount that is less than $5,000 or an amount that is more than $5,000? Okay, so what happens? We have here the contract rate of interest. That was the rate of interest that we saw on the face of the bond, right? That won't change. That stays the same no matter what. Meanwhile, we're going to have what? We're going to have market rate of interest, which will fluctuate. It is rare that the contract rate exactly matches the market rate, and if it does, it's only going to match it for one day, and by the next day, what? The market rate of interest is going to have moved, and there'll be a difference between the coupon rate, the stated rate, the contract rate. All of those terms are synonymous, and what? And the market rate of interest. So if the contract rate is 10% and it so happens that the market rate of interest is what? Also 10%, then the bond will issue at the face value. The bond will issue at $5,000. If we're in a situation where the contract rate turns out to be what? Less than the market rate. Contract rate is 10, market rate is 12%. The bond will issue, and we call it a discount. The bond will issue for less than the face value. We call that a discount. Now think about it for a minute. Why does it issue at less than face value? Why at a discount? Well, would you want to pay full price for a bond that is only paying you 10% when the market is paying 12%? No, you take your $5,000 and go somewhere else and get a bond that's going to do what? Give you 12% return, right? So the company says, wait. Don't go yet. I'll discount this. I'll issue it to you for less than its face amount. Now you're being compensated for the fact that what? The market rate of interest is above the coupon rate, right? So if the market rate is more than the coupon contract stated rate, those are all synonymous terms. That won't change. It'll be 10% from the day the bond is issued to the day the bond matures. And that amount is less than the market rate. That bond will do what? Issue at a discount. Now you see that we have the other alternative here, which is what? The market rate of interest is less than the coupon stated rate of interest. So what happens here? The company sits up here and they says, hey, you want this bond? And everybody says, yeah, I want that bond because it pays 10% when the market's only giving me 8%. They say, well, if you want this bond, get in line, everybody. In order to get this bond at this higher rate of return, you're going to have to pay a premium. So now you pay what? You pay more than face for this bond. You have to pay a premium on this. Why? Because you're willing to do that because you're going to get a better return than what? Than the market is giving on this particular bond. Okay? So again, let's do it together. Bond issues for face the market rate and the contract rate are the same. The bond will issue for what? For face, right? Okay. If I'm sitting there and the market rate is less than the stated rate of interest, the contract rate, the bond is going to issue for a premium. If the market rate of interest is more than the contract rate, the stated rate, the coupon rate, the bond is going to do what? The bond is going to issue at a discount. Okay. Now, what we're going to look at here is a very mechanical process that is going to allow us to actually determine what that bond should sell for. Okay, what we're going to use is basically present value accounting to determine what the bond should issue for. Now you look at this example and you can see up here that we have what? We have $1 million on the bond. That is what? That's the face value, right? Okay. Then what? Then they tell us that this bond is a semi-annual bond, which means it has 2 interest payments, one on June 30th and one on December 31st, right? Okay, so that's the 2 interest payment dates. It's a 5-year bond. So if it's a 5-year bond and it pays the interest what? Twice a year, how many payments are we talking about? 10 interest payments, right? Good. So that's going to be 10 interest payments that are going to come off of this bond. And they tell me that and again, in this example, they're calling it the coupon rate. Okay, again, we could also call that what? We could call it the stated rate. And in most of our questions that we're going to be looking at here in a little while, we'll call it what? The contract rate. Contract rate. That says contract. Okay, so we can have what? We can have stated rate. We can call it stated rate. We can call it contract. We could call it coupon. Most of the time, we're going to call it the contract rate. Okay. Now, let's see if we can figure out what the interest payments are going to be. We're going to get what? 2 a year, right? 1 every 6 months, 2 a year. And so the way we'll figure out the interest payments is we'll take this $1 million. And we will multiply that by the contract rate, which is what? 10%. But how many payments do we get a year? 2 a year. And so we're going to have to sit there and multiply that by what? 1/2, because what? We're trying to figure out what the payment's going to be every 6 months. Every 6 months is half the year, isn't it? Okay, so the million times 10% times 1/2 means that every 6 months we're going to pay interest of what? $50,000 if I'm doing my math right? Every 6 months, $50,000 is going to be paid out on this bond, right? Now you take a look at this and what happens? Year 1, we pay $50,000 on what? 6/30. We pay $50,000 on 12/31, don't we? That's year 1. Did we make 2 interest payments of $50,000? Then what? Then we go ahead and in year 2, we pay $50,000, $50,000. Year 3, $50,000, $50,000. Year 4, $50,000, $50,000. Isn't this fun? Year 5, $50,000, $50,000. Isn't that great? So we paid $50,000 every 6 months. We had 10 payments of $50,000, right? Now, in year 5, we also have to pay back the principal as well, don't we? And the guy's not going to just take the $50,000 and say, okay, keep the $1 million, no problem, right? No, he wants the $1 million back in addition to those payments, right? So if you think about this bond is really a stream of payments, isn't it? It's $50,000, $50,000, $50,000 every 6 months, and it is what? And it is $1 million at the end, okay? So if, in this example, the coupon rate and the stated rate are coupon rate and stated rate are synonymous terms. If the coupon rate and what? The market rate are both 10%, then this bond will issue for what? For $1 million for face, won't it? Right? Because the market rate and the interest rate are exactly the same. Now, what happens? That's just the mathematics of finance. The mathematics of finance is a beautiful thing. It's what? Poetry in motion, isn't it? It sits there, and we said market rate is the same as the contract rate, so the bond issues at face. Now, we come over to this example now, and it's going to be the same bond, but the only thing that has changed now is that the market rate of interest is 12%. The coupon rate is still 10%, right? The coupon rate's going to be the same regardless of what happens in the market. So the stated contract rate is 10%, but now the market rate is 12%. Market rate is what? Now more than the contract rate. So this bond going to issue at face, premium, or discount? Good. This bond's going to issue at a discount. Very good, guys. This bond's going to issue at a discount because what? Market rate is more than the coupon rate, the stated rate, the contract rate, right? Again, those terms are synonymous. So what happens? Notice it's still the $1 million bond that still has the 10% coupon rate on it. So one of the important things that we're going to have to realize is what? We will still figure out those $50,000 based on the face amount times 10% divided by what? Divided by 2, or I guess I'll be consistent since I multiplied it by 1/2 before. I'll just multiply it by 1/2. So that's still going to be what? $50,000. That's not going to change. The fact that we have a different market rate is not going to change that 50,000. The 50,000, the periodic, it's not always 50,000 of course, but the what? Semi-annual usually interest payments are based on the face of the bond times the interest rate on the bond, and that's not going to change. That's 50,000, 50,000, 50,000, 50,000, right? That won't change, and you can see that that's listed here, 50,000, 50,000 every 6 months, right? That hasn't changed, and we are also going to do what? Pay back the $1 million at the end of this bond, aren't we? So that won't change either. So the only thing that has changed here is the market rate of interest is 12%, right? So we're going to have to do some mechanical calculation to figure out what we should pay for that bond, and we're going to have to use something called present value accounting. Okay? When we use present value accounting, we're going to see that the future amount is always more than the present amount. Okay? Or the present amount is always less than the future amount, however you want to look at that. Think about this for a minute. Let's say you don't know me. I'm a complete stranger. And I walk up and I say, hey, can you help me out? Can you let me borrow $1 million? I'll pay you back, I promise, in 5 years. What are you going to say to me? Huh? You want a contract or something, but you don't know me. Huh? Okay, so you're saying, no way, I'm not going to sit here and give you $1 million to hang on to, and I don't see it again for 5 years. Forget about it, right? So let's say I say to you, okay, look, give me 900,000, and I'll give you back $1 million in 5 years. Give me just 900,000 now, and I'll give you $1 million in 5 years. How about that? Okay. Give me $1 now, and I'll give you $1 million in 5 years. How about that? Okay. So at some point, what? We hit a situation where the person says, okay, that's a good deal. You give me what? You give me an amount less. The present value that you're giving me is worth less than what? Than that $1 million that's going to come in the future, right? Okay, so when we use this present value accounting, we're sitting there and saying, hey, if I got to wait 10 years for some money, that's going to be what? Worth less today. So I'm only willing to give you a smaller amount today for the opportunity to receive a what? Larger amount in the future. Okay, this is the way present value accounting works, and so we're going to see in a mechanical fashion how we're going to discount these amounts that this bond is going to be paying out over the what? Over the next 5 years, over the next, what, 10 semi-annual periods. Okay, my man, thanks. Good to see you. Over the next, what? Over the next 10 semi-annual periods. Okay? So let's just go ahead and let's take a look at how we'll do this. And notice we've got what? We've got this present value of $1, and we've got a factor here of 0.55839. Okay? We're going to take that number and multiply it by the million. So this present value of a dollar figure is going to give me the present value of that what? Of that $1,000,000 it's going to be paid back in what? 5 years from now. It's going to tell me the present value, isn't it? And of course, if I multiply a million times 0.55839, the present value of that is less. So we didn't lie here. Just from a mechanical mathematics standpoint, they give us a factor that we can use to determine what the present value is, an amount that's going to be paid out, what? 5 years from now, or 10 semi-annual periods, right? Now look, guys, we're down to the last part of this class now. So there is no more, well, I'll figure this out tomorrow. Let me take a nap now. And tomorrow, I'll look at this. There's really no more tomorrows. We've got tonight. We've got the next class, and then we are preparing for the final, and then we're taking the final after that, right? So, people deciding to check out of the class and stuff and not come to class for some strange reason are setting themselves up for a C, D, probably an F, okay? And so you want to, I'm preaching the choir a little bit, but you want to stay in tune with this because, they will force me. I'll have no choice. I'll be forced to give you an F at some point, okay? And that part, neither you nor I will like very much, okay? All right, so let's see, though, where they come up with this factor, 0.55839. So you come over to this table, and this table is called present value of a dollar. Present value of a dollar. That is telling me that I want the present value of a one-time payment. It says a dollar. That means it's a one-time payment. Present value of a dollar. And so I come over and I start to make some calculations here on this thing. I guess I can make that a little smaller. Start to make some calculations on this, which is what? Remember the market rate of interest was what? 12% on that bond, wasn't it? 12%. I divide that 12% by 2. That gives me a 6% semi-annual interest rate. I have to use the market rate of interest, but since it's a semi-annual bond, I have to do what? I have to divide that by 2, don't I? Okay, so that gives me 6%. It's a 5-year bond, but how many payments do I have? I have 10 payments or 10 periods that I'm going to have to count here for, because even though it's 5 years, they pay me what? Twice a year, right? Okay, so I come over and I find the 6% column for my interest rate. I find the 10 period, 10 payment row. I come across and I see that number there, it's a little hard to see because I've circled it so many times now. I've started to obliterate it a little bit, but it's 0.55839, isn't it? Okay, so you come over back to the example, and sure enough, that's what we did. We multiplied that $1,000,000 times what? 0.55839, and when we did, we got the present value of that principal, didn't we? Okay, so we've got that present value of that principal. Now, we go ahead and we have to pick up for the present value of the interest. The interest is what? 50,000 every 6 months? Okay, so we've got those 50,000s up there every 6 months. And so as we start to take a look at the interest, oh boy, we're going to get played with by the pen here, right? Have to go through this once every time. There it is. Okay, so we're going to have what? These 50,000s every 6 months. So we bring down what? We bring down that 50,000. But now we're going to multiply it by a factor that is called present value of an annuity. Present value of an annuity, meaning an annuity that what? That is not one payment. When you have a stream of payments that are going to pay you out over so many years, when you retire after you graduate from Ohlone and you go on and you go to a transfer school and all that, and you make big money, and then when you retire, you're going to say, hey, I want a retirement pay. Will you take 50,000 every 6 months for the rest of your life? Why does everyone always think about that? I always get students like, I don't know. Tell me that right now, man. I'll take it. Huh? 50,000 every 6 months is not 100,000 a year. Is it? Yeah, I guess it is, huh? I bet you'd still take it. 50,000 every 6 months. What's that? Huh? It's almost 10 grand a month. You'd probably take that. Huh? In retirement? Huh? You know, guys need to quit dreaming, okay? I mean, you're not going to find yourself in a situation where you're collecting a retirement check at 10 grand a month. That's not going to happen. Okay, you might as well forget that, okay? You might get something like, 3,000 a month, 4,000 a month, maybe 5,000 a month. 10 grand a month, I don't think so. Okay, I don't think that's coming in retirement. Okay, now maybe, okay, whatever. Dream as much as you want. Well, I mean, what's his name? Zuckerberg will get that in retirement, and you might be the next Zuckerberg. So go ahead, you can think about that, okay? So what happens? We've got this 50,000, but it's a stream of payments, isn't it? It's an annuity, okay? It's a stream of payments. We call that an annuity, and what happens? We come over and we can't use this present value of a dollar table because that's for just what? One payment. This is what? This is a stream of payments, so we literally have to go to a different table. We go to the present value of annuity table, and we are supposed to use what interest rate here? We have to use this 6%. Again, it's going to be what? 12% divided by 2. Why do I have to go through this every time? Okay, so it's going to be, again, 12% divided by what? 2 equals a 6% semi-annual rate. How many payments? 10 payments twice a year. What? For the next 5 years, it's 10 payments of 50,000, right? Okay, so I come over to the 6% column. I come down to the 10 payment row, and I find a factor here of what? 0.736009. Is that the factor? Okay, so I come over and I multiply that 50,000. I multiply that 50,000 by what? Why is this thing making all kinds of decisions for me? Okay, so I have that what? I take that 50,000 and I multiply it by the 7.36009, and that does what? That now gives me the present value of the interest, which is $368,005. So I've got the present value of the principal. I've got the present value of the interest here, don't I? Okay, I go ahead and I add those two amounts together, and when I do, I get this $926,395. That is what someone is willing to pay for this bond at the market rate. I discounted these cash flows at the market rate of interest, didn't I? Is it less than $1 million? It is less than $1 million. Don't you love the mathematics of finance? It's sitting there and saying, hey, if you have a bond that's going to be paying $50,000 on $1 million face, that is what? That is a 10% return. Meanwhile, if you're trying to figure it out in the market rate, you discount those cash flows at 12%, and sure enough, it does what? It gives us a purchase price on this bond that is less than the face, isn't it? Okay, so this bond issued for less than face. So when we get the bond, the journal entry that we will make, we're the ones borrowing the money, so the person's giving the company the money, aren't they? So we'll debit cash. How much cash are they going to give us? $926,395. We will always credit bond payable for the face. If the face is $1 million, we credit bond payable for $1 million. If the face is 5,000, we credit bond payable for 5,000. So we always credit what? Bond payable for the face of the bond, $1 million. Do we need a debit or a credit to make this journal entry balance then? We need a what? Debit, and the debit is for $73,605, isn't it? So we go ahead and we debit that for $73,605, and we debit this bond issued at a discount, so we debit discount on bond payable for the $73,605, right? how much are we going to have to pay the guy back? How much do we pay him back? We pay him the $50,000 every 6 months, and at the end of the term of the bond, how much do we pay him back? Huh? What? No. What do you mean 1.5? We've been paying him. No. How much do we pay him back at the end? We've been paying him 50,000, 50,000, 50,000, 50,000, 50,000. We've been paying that every 6 months, right? Then we've made all those interest payments. Then how much do we pay him? We pay him $1 million at the end, don't we? So we pay him back the full million, right? Meanwhile, he only loaned me what? $926,395. So what's happening? He's going to get an extra $73,605 at the end of this thing, isn't he? Right? And that extra $73,605 is catching him up for all the time that my stupid bond was paying 10% when the market wanted what? Market wanted 12%, right? So he finally gets caught up at the end, doesn't he? Okay. Okay, so what happens? Let's just go ahead and at this point, let's make up a little chunk of balance sheet over here. Okay, so if I'm doing my balance sheet over here, immediately after issuing this bond, and I'm just going to do the liability section. We know there's cash up there, that 926, but I just want to look at the liability section. How much is my bond payable? Don't be creative. My bond payable is $1 million. Very good. I credit it for $1 million. It's going to show $1 million, isn't it? Right, guys? Bond payable is $1 million. Okay. Then I'm going to report that discount. So if the bond payable was what? Was a credit for $1 million, and the discount is a debit for $73,605, then it is essentially subtracting off of that face amount, isn't it? Off the bond payable? The discount? Yes. Bond payable is a credit, discount is a debit. That difference then is what we call carrying value. So the carrying value, trying to squeeze that in, carrying value of this bond is what? $926,395, which is exactly what the guy loaned me, isn't it? So at issue, the carrying value equals what the guy loaned me, right? He loaned me $926,395. The carrying value is $926,395, right? The discount, we call that a contra liability. It's a contra liability because what? That's his contra liability. It's a contra liability because it's going against the liability. It's opposite the liability. Just like accumulated depreciation was a contra asset because it went against the liability, but what? Our equipment was a debit, the accumulated depreciation is a credit. Here we've got the mirror image, right? The liability is a credit, the discount is a debit, but it's a contra liability, and it reduces the carrying value of the bond, right? Okay. Okay, good. So this bond issued for less than face because it was a discount bond, right? Okay. Okay, good. Let's come over and let's look at another example here now. And this time it's going to be what? Premium. So I know that the market rate's got to be what? Got to be less than the coupon stated rate, etc., right? So again, only thing that changes here is the market rate of interest. The stated rate, the coupon rate, stays exactly the same, doesn't it? The contract rate stays the same, okay? So since that stays the same, that means then that I'm going to have the $1 million times what? Times 10% times 1/2. So what's the interest going to be every 6 months? Going to pay the guy $50,000 interest every 6 months. There it is, 50, 50, 50, 50, 50, 50, 50,000, 50,000, 50,000, 50,000. And then I pay the guy back what at the end? I pay him back the $1 million at the end. So none of that has changed here, right? That's all exactly the same. The only thing that has changed is the market rate of interest, right? Okay, and that market rate of interest is what I'm going to use to determine how much somebody should pay. So I'm going to go ahead and get the present value for the principal. There's the present value factor. I'll multiply that times what? Times 1 million. Times 1 million. So I'm going to go back to the table. Should I use this one or this one? This one. Good. Present value of what? $1, the one-time payment for the principal, right? Okay. Now, if you ever get stuck and you're saying to yourself, which table should I be on? We know that that present value of that one payment has to be what? Has to be less than the future amount, right? So that means all the numbers on this table have to be what? Less than 0, don't they? I mean, not less than 0, less than 1, excuse me. Less than 1. Okay, so they all have to be less than 1. And so now I'm looking and I'm what? 8%? But I have to divide that by what? 2. So now I need to go to the 4% column on this thing. Good, guys. 4% column. It's still what? Still 10 periods. So I come over to the 4% column and 10%, 10-year row, I should say, and that's 0.67566, whatever. 556, okay? And so I go now back to the problem over here that we were just looking at. Sure enough, that's the factor. That's where they got it, right? See that factor down there? Okay. Okay, good. Now I need to do it for the interest. The interest is what? Is an annuity, so I have to go to the present value of the annuity table, right? Okay, so I go back to the present value of the annuity table now, and how do I know that I'm on the right table? Well, it says annuity, but what? Also notice that except for the one payment row, all of the numbers are greater than 1 because we have more than one payment, don't we? Okay, now I'm of the opinion that the first thing that Trump should do when he's elected president is pass a executive order to get rid of that first row of the table. If he really wants to make America great again, he should get rid of that first row on the annuity table because, look, if it's a one-time payment, then it's not an annuity. So why do we even have that one there? They should just get that row off of there, right? Wouldn't that make America great again if they did that? Okay? That way we're not confused. We know, hey, that's right. There's not the one payment. It's more than one payment. It's got to be what? 2 or more payments, right? And then all the numbers will be greater than 1. If I'm sitting here and it's one payment, I really should be on the what? On the present value of the dollar table, and you would see if you compared the two tables that all the numbers on that one row are exactly the same because it's just one payment, right? Okay? Okay, so what happens? We sit here, we know we're on the right table, all the numbers are greater than 0. It's these tables aren't regulated. Some maniac could have made this table for all I know. I mean, I got it off the internet. I think the numbers are all okay. But I've seen, and I don't know who legislates these tables. I see some tables that go all the way out to 50%. Some tables stop at 12%. Some tables decide to not put a number on there that I need. So they go from 22% to 25%. I don't know who told them to skip 23 and 24%. I don't know who they think they are. But they go ahead and they do that. So there's absolutely no standardization to these tables, okay? All right? It is all based, by the way, guys, on a formula. There's a mathematical formula that derives what these come to. And the formula is really what, God uses. And then people go ahead and they sit here and they come up with these tables to help us. And really, these days you'd use a present value calculator that would allow you to calculate, or you can even use a present value function in Excel, and it'll do it for you. Okay, but I'm just showing you the table just so you can kind of visualize what's going on here. But there's no standardization to these tables. My only point is that if you're ever dealing with a table, you know that you're on the annuity table when what? All the numbers are greater than 1. You're on the present value of the dollar table when all the numbers are what? less than 1, except for that stupid first row. Okay, now you come over and you have what? Do you think Trump will change that for us? So you have 8%, and you divide that by what? You divide that by 2, because 8% was the market rate. That gives me what? 4% now, and it's 10 payments, right? So I come over to the 4, I come over to the 10, 8.11090. Okay, and so I go back to the problem now, and that was the number 8.11090, right? So we pick up the right factor. So we multiply the present value of the dollar factor times the principal. We multiply the present value of the times the principal. We multiply the present value of the annuity factor times what? Times my interest. We go ahead, we add those two numbers together. This bond issues for $1,081,105. This bond issues for more than face, doesn't it? And we knew going in it was going to issue for more than face because it's paying a 10% interest rate when the market wanted what? Market wanted 8% on this bond. So we knew it was going to issue more than face. All we're doing here is the mechanical calculation of it, right? Okay. Okay, good. So then we can use these numbers to make the journal entries up. And when we do that, we go ahead and we do what? We debit cash $1,081,105, right? Debit the cash $1,081,105. We always and forever credit the bond payable for $1 million, right? I don't care what happens to the amount of cash that we get on issue. We'll always credit the bond payable for $1 million. We needed a credit to make this journal entry balance, so we credit what? We credit premium for $81,105, right? Okay. Question?
So that means when this bond comes payable, the borrower's going to pay him the $81,105 to get that rate?
No. When this bond comes due, the borrowers only pay me $1 million back. They only pay me $1 million back when this bond comes due. I get to keep that extra $81,105. That's compensating me now for all the time that my what? That my bond was paying 10% when the market only wanted what? 8%. So I keep that premium. I keep that extra $81,105.
Then you would clear that out. You debit cash $81,105 because it'll go back into your cash at that point.
We're going to amortize that over the period of the bond. We're coming up on that. Okay?
How does the 81,000 transfer to you?
He just gave it to me.
I thought he only gives you $1 million.
How much cash did I get?
1,000,000.
81,105. I got the cash?
Yeah.
Try and take it from me. Go ahead.
So the person who borrows it gives you the 81,000.
Who?
The person who borrows the money gets.
We're borrowing the money. We're doing the accounting for the company that is borrowing the money. We're borrowing money, aren't we?
Yeah.
If I'm debiting cash?
Yeah.
How much cash are you giving me?
1 million.
1 million what?
Bond.
How much cash are you giving me?
1,081,000.
You're giving me 1,081,105, right?
Yeah.
Okay, and I'm going to keep that extra 81,000. I'm only going to pay you back what? I'm only going to pay you back $1 million at the end of this bond. I'm going to keep that extra 81,105.
Oh, okay.
I'm going to keep it.
Yeah.
Thank you. Try and get it from me. Go ahead. You can't get it from him, right? He's got it now, doesn't he?
Yeah.
And you're like, first you think, well, give me my 81,105, man. What kind of deal is this? And I say, hang on a minute now. We had a contract. I paid you 10% when the market wanted only 8%. You begged me for this bond. Don't come and ask me for the 81,105 back. What's wrong with you? What, do you want your cake and eat it too? You got, what, 10% all that time? Now you want to come and you want me to give you the 81,000? No way. The deal was I get to keep that, right? And that compensates me for what? For all the time that, what, my bond paid you 10% for what? For 5 years. Every 6 months, 50,000, when the market was only willing to give you, I don't know, 40 something thousand on that, right? In fact, it would be 40. It would be 40,000, wouldn't it? The market was only willing to give you 40,000, and I gave you 50. If you went and found another bond at the market rate of interest, another $1 million bond at the market rate of interest, $1 million times what? 8% divided by 2 would have only given you $40,000 every 6 months. Meanwhile, you came over here to the big dog and you got 50,000 every 6 months. So I'm going to keep that extra 81,105. Okay? Okay. So that's the deal that they go ahead and they agree to that, right? Now, all that's left at this point then is how we account for every 6 months the situation that I'm going to pay you 50,000 when really what? My interest expense is going to be an amount that is less than 50,000 because I get to keep that extra 81,105, right? Okay. For the discount bond, we're going to sit here and we're going to now have to account for the situation that what? You only gave me $926,395, and I'm sitting here and I got to pay this bum $1 million now. I got to pay him an extra $73,605. That's right, because what? He loaned you money at a market rate of 10% when the market, at a contract rate of 10% when the market wanted what? Market wanted 12%. So, of course, he's going to what? Expect a little bit more back at the end, right? And our job is going to be to account for that. Okay? So you come over and you take a look at how we will amortize this discount using something called straight line. Okay? Now, you may have heard Jim and I talking. I don't know if you heard us talking at the beginning of class. I said, yeah, we're just going to talk about straight line. FASB would prefer that companies use something called the effective interest method. We do not get into that in this class. The rule is that the effective interest method and the straight line give you don't give you materially different answer. It's okay to use straight line. We're going to teach you straight line just so you understand the mechanics of it. If this was an intermediate accounting class or something, I would teach you the effective interest method, and we would just kind of say, remember straight line? Okay, now let's deal with effective. But in this class, we're just going to use what? Straight line. Okay? So what happens? We go ahead and it was $1 million. I'm going to turn this to red. This blue gets a little hard to see. Why does it do that? Oh, I turned it back to blue. Okay, so I'm going to go ahead and make this red here. And notice that what? We've got this $1 million, okay, which was the face of the bond. How much cash did you give me? 900. No, you gave me $926,395. It issued it less than face, right? Okay, so there was a difference of $73,605, right? So what we're going to do is we're going to amortize that $73,605 over the 10 semi-annual periods. Over the 10 semi-annual periods, we have what? 5 years, 2 6-month periods every 5 years. That's what? That's 10 semi-annual periods. Okay, and so we're going to amortize that, and using straight line, we're going to amortize the same amount every 6 months. Now, what's going to happen? You loan me $926,395. I'm going to pay you back the full $1 million, right? So you're going to get an extra $73,000. I'm going to have to pay you an extra $73,605. So if you think about it, that's driving my interest cost up over the $50,000 here, right? Because I got to pay you that extra $73,605. Okay? So what happens? Notice our buddy $50,000 does not change. It doesn't change. It will always be what? How do we get that $50,000? $1 million times what? Times 10% divided by 2 or times 1/2, however you want to do that. 50,000 will not change. 50,000 is like your best friend, isn't it? What do you say to your best friend? Promise me you'll never change. And your best friend says, okay, I'll never change, right? So 50,000 is never going to change, right? That's our buddy. 50,000, 50,000, 50,000. That won't change, but what? But I'm going to go ahead and I'm going to add the amount of discount amortization to my what? To my cash interest every period to figure out my interest expense, and it is increasing my interest expense above the 50,000 because we're getting to the day when I'm going to have to pay the guy what? That extra 73,605, right? So if you think about it, my interest expense really is more than the 50,000 cash I'm paying every 6 months, right? Okay, so what happens when I go ahead and I do this? I debit my cash right down here. This is the first interest payment. The bond was issued January 1st, pays interest June 30th, December 31st. So for my first interest payment on this in year one, I debit the bond interest expense for how much? The 57,000, whatever, the what? The 50,000 cash that I'm going to pay plus the amortization of the discount in this case, right? Okay. Then what? Then I go ahead and I credit the cash because I'm paying the guy 50,000, 50,000 no matter what for the next 5 years, right? Every 6 months, I pay him the cash. This is his interest. He was going to want that money. And then I credit the discount. Now let's think about the discount for a second. I'm going to go ahead and tee up the discount right here. Here's my discount. Going to tee it up right here. That's the discount. And when I initially issued the bond, remember we debited the discount? Didn't we debit the discount? 73,605. Okay. Okay, good. And then just now I did what? I credited the discount, didn't I, for the amortization? That's 7,360.50. Okay. So what's the balance in here now? I always get locked in against somewhere where I can't go. Let me fix that. God, that gets irritating. My whole life is spent squeezing numbers into places that they don't want to go to. Did I lose the screen? No? No. Okay, so let's see. I'll do it, I guess, right here. I guess. Discount. I originally debited for what? 73,605? Okay, and so it had a balance right at that moment of what? 73,605? Okay, good. Then I just credited it for how much when I amortized it? 7,360.50 cents. Okay, so what's the balance here now? 66,244 and 50 cents, you say? Okay, good. Thank you. 264.50 and 50 cents. Okay, so the discount has come down, hasn't it? Discount's come down. Okay, so now what? Now when I go ahead and I guess I'll put my balance sheet up here. I should be able to do my balance sheet up here. What's the amount of bond payable? Don't use your imagination. Bond payable, it was $1 million, wasn't it? That didn't change. Okay, good. How about my discount now? How much is my discount? You just told me the discount is what? 66,244.5. Okay, so what's the carrying value of this bond now then? I'm just going to put CV. Carrying value of the bond is 933,755.50. So the carrying value of the bond came up, didn't it? The carrying value of the bond came up. Why did it come up? Because I made the discount less, and the discount is becoming less because what? I'm going to eventually pay the person that extra $73,605 when I pay them the full million, and so it's getting closer to where I'm going to have to pay the full million, right? So the carrying value comes up, and if you look here as we discount that, amortize that discount, I should say, every 6 months, notice that eventually after that last amortization of the discount, the bond is showing $1 million, which is what I'm going to have to pay the guy, right? Isn't accounting beautiful? Look at that. Poetry in motion up here. Look at this. Right? Okay, so when you think about amortization of a discount, it does two things. It increases my interest expense above my cash interest of $50,000, and it also does what? Increases the carrying value, and for both of those, it does it by the amount of the discount amortization, doesn't it? My interest expense was $57,000 something, and because I reduced the discount by the amount of discount amortization, and because the discount's a subtract from the bond went up by the amount of discount amortization, didn't it? Right? Question? Okay, good. Let's look at the premium bond then. Let's see what happens here. And again, the only thing that's changed is the premium bond. And so we, issued the bond for $1,081,105. The face of the bond is what? $1 million. So the premium is $81,105. We divide that by the 10 semi-annual periods. That means we're going to amortize $8,110.50 every 6 months off of this premium using straight line, right? Okay. How much cash am I going to pay every 6 months? Huh? 8,000. 50,000. That won't change. It's going to be what? 1 million times what? Times 10%, the coupon rate divided by what? Divided by 2, or times, would you say times 1/2? Times 1/2, however you want to do that. Okay, that's going to give me 50,000. That's not going to change, right? Okay, but I'm going to amortize that premium, right? And I'm getting closer to the day where I'm going to only pay the guy back $1 million. I'm going to get to keep that extra $81,105. So that's bringing my interest expense now what? Down below the $50,000, isn't it? Okay, and so you go ahead and you subtract the amount of premium amortization from the cash interest, and that gives me my interest expense. And sure enough, it needs to be below 50,000 because my interest expense is not 50,000 because I'm going to get to keep an extra 81,105, right? Right? Okay. So I go ahead and I debit my interest expense for that amount, the cash interest minus the premium amortization. I credit the cash. What's my buddy's name? No, I don't care what your buddy's name is. I want you to know my buddy's name is what? Is 50,000. Okay, I'm going to credit the cash for 50,000, assuming this stupid thing will let me do it. Okay, I'm going to credit the cash for 50,000. The stupid thing's going to get in my way and won't let me credit the cash. Underscore that, but I'm going to credit the cash, right? Okay. Then what? Then I go ahead and I do what? I need a debit to make this journal entry balance. I debit the premium, right? Okay. Now, when I issued the bond, I had done what with the premium? Guys, you need to listen to the question and answer the question. When I issued the bond, I did what to the premium? I credited. Okay, we got debit on the left, credit on the right. When I issued the bond, I did what to the premium? I credited it. hate this classroom. Just because this thing doesn't want to stay in. It's not going to stay. Okay, so what's going on? I'm sitting here and I did what? I credited the premium, didn't I? When I issued the bond? I credited the premium, right? To make the journal entry balance. So let's just go ahead and let's take a look over here then. I'm going to erase this. And that's going to be the premium. And when I issued the bond, I credited it for what? 81,105. So that gave it a balance of 81,105. Okay, good. And then when I amortized the premium, I just debited it, didn't I? For what? 8,110.50. So that gives it a balance now of how much? 72,000 what? 994 and 50 cents. Like that? Yeah. Okay. And so what happens? When I prepare the balance sheet now, how much is the bond payable? Don't be creative. Bond payable is what? 1 million. How much is the premium now? It is 72,944.50. 994. 994.50. And the premium does what? The premium was a credit, so the premium adds to the carrying value, doesn't it? So the what? The carrying value is now 1,072,944.50, isn't it? 994.50. So if you look, the carrying value has done what? Carrying value has come down from when I first issued it, hasn't it? And the carrying value needs to come down because how much am I going to pay this guy off at the end? I'm going to pay the guy off a full $1 million at the end of this bond, right? I'm going to get to keep that extra 81,105. And all we're doing here is we're recognizing the fact that I'm going to get to keep that extra 81,105 is decreasing my interest expense below the 50,000, and we're just what? Allocating it to each period, aren't we? Question? Question? Okay. What did it do? Turn it into CinemaScope up here or something? I don't know why it's just now this big wide image across the middle of the screen. But let's talk about something called the debt to equity ratio. Okay? Debt to equity ratio is going to measure how much debt we have relative to our equity, you think? Okay? And so what happens? We'll put our total liabilities in the numerator, and we'll put our equity in the denominator, and that'll give us a ratio of debt to equity. Okay? If a company goes bankrupt, who gets paid first? company goes bankrupt, we have to liquidate, and we're going to start to try to pay off all of our creditors, etc. Who gets paid first? Huh?
Government.
What'd you say?
Government.
The bank? Okay.
Bank has to be in first position.
Who gets paid first? The accountants and lawyers get paid first, because if the accountants and the lawyers aren't there, nobody figures out who gets paid anything, right? So the accountants and lawyers get paid first for the work to figure out who gets paid what next, okay? Next would come what? Taxes, any taxes that are owed, etc. would come next. If employees are owed salaries, they would come next, okay? Then who gets paid? Now the creditors get paid after that, which could be the bondholders. Anyone who holds secured debt would get paid first. For example, if I'm a bank and I have a mortgage on the building, when they liquidate the building, I would get whatever is coming out of that liquidation of the building. Then if there's anything left, the what? Unsecured creditors, which bondholders are typically considered unsecured creditors, they would get paid. Who gets paid last? The stockholders get paid what? Get paid last, right? So a way to measure how far back in line you are is to come up with this thing called what? The debt to equity ratio. Since our liabilities have to be paid first, we can see how far back in line we are. Now, when we look at this company, we're only 1.7 behind in line, and we're a little over the industry, but not too bad. Then what? Then we keep going, and this situation is getting worse and worse for this company, isn't it? As they what? Accumulate more and more debt. The stockholders are getting further and further back in line, aren't they? So if I wanted to raise some capital and I didn't want my stockholders to get further and further behind in line, what would I do? I need money. I want to build a building. I could issue debt. Is there another way I can get some money? A loan is a liability. That's not going to fix this situation. A bond is a loan. It's just a certain sort of contract that we're dealing with a bond. It's still borrowing money. If I didn't want to borrow money and I needed money, what could I do?
Offer more stock.
I could issue more stock. I'd get money in that way, right? If I issue more stock, what am I doing, though? The more stock I issue, I'm diluting the ownership in the company, right? And if that's voting stock, pretty soon, instead of me deciding what's going to happen, somebody could be telling me what's going to happen, including you're fired, right? Okay, so what? The more stock you issue, think about it as your house. Let's say you have your house and you say, well, I want some more money because I want to build a wing on my house. Let me see. I know I'll sell shares in the ownership of my house. So you sell shares in the ownership of your house, and now all of a sudden someone owns a significant amount of the ownership in your house, and they say, hey, do you mind if we park our motorcycles in the living room? You're going to say, well, okay, I guess I got to let you do that since you own a certain amount of this house. And you're saying the living room part is what? Your ownership share, and I guess I better let you do what you want with it, right? So the more you issue shares of stock, the more what? The more you lose control as to how the company's going to operate, right? So a company would have to sit there and be very careful, and there is an optimal mix between debt financing and equity financing that you'll learn about in finance classes, where they'll sit there and they'll come up with the right balance between the debt and the equity financing. This is more after the fact. This is simply a measure, isn't it? And I take my total liabilities divided by my total equity. That gives me my debt to equity ratio. Okay? Okay, so you want to look at some questions now or break now? Okay, let's go ahead. Let's take the break. We'll take about, I guess we can afford to take, let's just take 10 minutes. That'll make it a little easier for us to get out on time. So we're going to take about 10 minutes. We'll come back. We'll work some questions from Chapter 10. And then Actually, what I'm going to do is, yeah, we'll work some questions for chapter 10, and then I'll get you your midterms back, okay? Or you want the midterms first? Chapter 10 questions, then the midterm? Okay. Okay.
That slide right there, I don't have it on my chapter 10 PowerPoint for me.
Okay. I'll put this up like this later. Yep. Quiz questions. And, I wonder if I put them all up there. Well, that's all right. We'll work the ones that are in the file, and then ones that aren't, I'll leave for you to work so you get a little practice over the break anyway. So let's just go ahead and let's take a look at this question number 1. So we have a bondholder that owns a $1,000 10% 10-year bond. That gives them the right to receive what at maturity? The full $1,000, the full $1,000,000, whatever. That's what they get at maturity, right? Yes. Okay. Okay, good. Let's take a look at number 2. The party that has the right to exercise the call option is the bond issuer, right? So remember, in our little example, that's the person that is going to be receiving the money. We have the issuer. That's the company, I guess, just to keep it consistent with the way we drew it before. That's the company. And then we have the bondholder, right? That's this little guy. And he does what? He gives his money to the company, doesn't he? Okay, and then what? And then the company, if they want to, they can say, hey, I want to call these bonds. I issued the bond. I want to call it. Here's your money back, right? And no more interest payments or anything from this point forward. And they can do that. And they probably would do that if we issued the bond at 10%. Meanwhile, interest rates fell to 6, 7, 8, 4, or 5%, whatever. Hey, we're paying too much interest, right? So we call those bonds. Okay, so the issuer can call the bond. Okay, good. How about this one? A company's... Uh-huh.
Is the call option like basically to cancel it?
Is the what?
The call option?
Is it what?
Is it like to cancel it?
Essentially, yeah, I guess you could call it, it's like canceling the bond. It's like sitting there and saying, hey, no more. We're done. I'm taking the bond back. Now, of course, they have to pay me at least my $1,000,000 and probably a little more than the $1,000,000 to call it, right? Because they're kind of canceling our deal, aren't they?
So
Yeah.
certain bonds are callable and are certain ones not.
Certain bonds are not callable. That's right. Not all bonds are callable. Usually they'll put them as callable, but they don't have to. Yeah, some bonds are not callable. Okay. Okay, good. Now, a company's total liabilities divided by its stockholders' equity is the debt to equity ratio. Do you have this question? This next one? Okay, good. So we take what? Using that formula then, if our liabilities are 15 million and our equity is what? 12 million, and we do the math here, we come up with what? This 1.25? Okay. Okay, good. When a bond sells at a discount, the contract rate, which is, in our little example, is 10%, is going to be what? Contract rate, I'll put that as CR, is going to be less than the market rate, I'll put that as MR. In our little example, that was 12%, wasn't it? Right? Okay. Okay, good. Number 5, amortizing a bond discount allocates a portion of the total discount to interest expense each period, doesn't it? Okay, because what do we have? 73,605 was the discount in our little example. And we divided that by what? 10 semi-annual periods, so that gave me $7,360.50, guys. Is that what it was? Right? Okay. And then what? I added that to my, what was my buddy's name? No, 50,000 was my buddy's name, not cash. Okay, so that's what? 57,360 and 50 cents. So it added to my interest expense, didn't it? The discount amortization? Right? Okay. What? No, the carrying value of the bond was the, how much is my bond payable? The bond payable was $1,000,000. And then I had the discount immediately after issue was 73,605. The carrying value, subtracting off that contra liability, gave me a carrying value of $926,395, right? And then immediately upon issue, the discount got debited for 73,605, right? So it had a balance of 73,605. The discount did. And then I went ahead and I just did what? I amortized it 7,360. So I debited interest expense 57,360.50, right? I credited cash for how much? What's my buddy's name? 50,000. I credit the cash always the coupon rate, stated rate, contract rate of interest times the face amount. If it's semi-annual times 1/2, that gave me the 50,000. And I credit the discount now what? Come on, guys. We just did this. You can't have that short term of memory here. We debited this what? 7,000 what? $360.50. Okay. And so we go ahead and we credit the discount 7,360 what? 0.50. That gave me what? 66,000. What was it? $244. $244.50. Okay. Okay, good. So now when I went ahead and I prepared my balance sheet, my bond payable is how much? Always $1,000,000. And now the discount is 66,244.50. So now the carrying value is 933 what? 755.5. So the carrying value is the face of the bond minus the discount, or can't be both, plus the premium amount, right? and the carrying value will come up as I get closer to the day that I'm going to have to pay the guy $1 million, right? If it's a premium, because it's above face, it's going to do what? It's going to come down towards the face value as I get close to the day when I have to pay the guy $1 million, right? Okay. So a discount on bond is called what? Contra liability. It's against the liability account, right? Okay, good. A discount on bond payable occurs when what? The contract rate, CR, is 10% and the market rate is what? 12%. So when the market rate is more than the contract rate, we have a discount, right? Okay. Number 8, when a bond sells at a premium, now what happens? Now the contract rate is, say, 10%, when the market rate is only, say, 8%. So the what? Contract rate is more than the market rate. The bond sells at a premium, right? Okay. Well, you can look at this on your own. It's going to be on there. Okay. What's the next question you have? Do you have this one? Okay. Okay, so let's go ahead and let's take a look at this question. And they want us to record the journal entry for the first interest payment. Okay. Now they tell us that this bond issued sold for $400,000 and the company received proceeds of $396,000. So did this bond sell at a discount or at a premium? Excuse me? It sold for less than face. That's a discount, right? Okay, so when it's sold, let's just do the journal entry when it's sold. I know they didn't ask us that here, but what's the sale journal entry? Journal entry for the sale. Okay, say it again. So you want to debit cash for the amount of cash. When they say they received proceeds, that means they got cash of $396,000. Okay, good. Any credits here you're interested in? Huh? Well, what do you want to do? You said something about bond payable? Good. Credit the bond payable for $400,000. Okay, good. What's your name? Lou? Jesse? Okay, Jesse. So you wanted to do what? You wanted to debit something over here earlier. I obviously need a debit of 4,000, right? And so Jesse, you want to debit what? You want to debit the discount, don't you? Okay. Well, I just want to debit discount because I have enough trouble making this thing right without having to write more words, right? So it's just a debit to the discount for 4,000? Okay, good. So I got a discount of 4,000, don't I? Now I have to amortize that discount, don't I? And that amortization on that discount, is that going to increase or decrease my interest expense? How much am I going to have to pay the guy back? 400,000. How much cash did he give me? 396. So my interest expense is being driven up by this discount, isn't it? Okay. So what am I going to do? Well, first I'm going to figure out the cash interest. Cash interest is always and forever. What's my buddy's name? 50,000, but it won't be 50,000 in this example because it's a what? $400,000 bond, and the interest rate on it is what? 7%. So I'll multiply that by 7%. In our example before, it was always by 10%. And then it's going to be, why are you saying 14? It's what? Times 1/2, because they tell me, where do they tell me it's semi-annual? Oh, they don't say semi-annual, but it's June 30th and December 31st, so that means it's semi-annual, right? So I have to multiply it times 1/2. So what's that give me? 35,000? Or 3,500, I should say? Or 35,000. What is it? 14. 14,000. So that gives me 14,000, right? But I have this amortization of this discount, don't I? Because I am going to have to pay the guy back that extra 4,000 at the end, right? So if you take the 4,000, you divide it by what? 10-year bond. How many semi-annual periods is that? That's 20 semi-annual periods. That's $200 every 6 months, isn't it? $200 every 6 months? And it drives up my interest expense above the cash interest, doesn't it? So what do? I'm going to go ahead and I'm going to debit bond interest expense, the 14 plus the 200, right? Just like it was the 50,000 plus that 7,000, whatever. Okay, so that makes it 14,200. What's my buddy's name? 14,000 this time. It's always what? The face times the contract rate, usually times 1/2 for semi-annual bond. That gives me the 14,000, and then I do what? Now I credit the discount because when I issued the bond, I did what? I debited the discount, and I want to make that discount less each period, don't I? Right? Okay, good. How about number 9? Do you have that one? Okay, let's go ahead. Let's do this one. Okay, so we have a 10 years, 7% bond with a par value of 100,000. The company received 96,526. What is the first semi-annual interest expense for the first semi-annual period? Did the bond issue at a discount or a premium? Discount or a premium? Why do you have to look that up? If the bond issues for less than the face, that is a discount. If it issues for more than face, that is a premium, guys. I mean, that's just like, ABC peanut butter and jelly. You put regular gas in, that's going to cost you the regular price. You put the cheap gas in, that's a discount. You put the expensive gas in, that's a premium, right? Okay, so this issued for less than face, so it's a discount. So that's going to be what? 100,000 minus the cash I got of 96,526. That gives me the discount of how much? 3,474. Okay, good. So we got a discount of 3,474, right? Okay. Now what's going to happen? We're going to sit there and we're going to amortize that discount over how many periods? 10-year bond, and it's what? Semi-annual. That means 2 interest payments, so it's what? 20 periods. 3,474 divided by 20 gives me amortization of 173.7. Good. Now my interest expense is going to go up by that amount, isn't it? Okay, so now all I have to do is figure out the cash interest. Cash interest is always what? Face of the bond times what? Times the contract rate, 0.07 times what? 1/2. What's that? 3,500? Can't be 35,000. 3,500? That's right. 3,500. Okay. So I add those together, don't I? Hello? So I get 36,7,370. Okay. Is that the answer? Good. Okay. Do you have this one? What's number 10 up here, right? Do you have this one? Do you have this one? Okay. So we have what? The market price of a bond is equal to, and it was equal to the present value of the future cash payments. It was equal to the present value of what? The interest, the 50,000, and equal to the present value of the principal when that paid back. Didn't we add those two together? Did we add those two together in the example? Hello? Okay. Okay. Do you have this one? 11. Okay. Okay, good. Adonis issued 10-year 8% bond with a par value of 200,000. Interest is paid semi-annually. The market rate is 7.5. Now look, if they told us nothing, we would know more. We would know this bond's got to issue at a premium, doesn't it? Okay. And sure enough, then they tell us that Adonis received more than face. So it did indeed issue at a premium, didn't it? Right? Now, which of the following statements is true? And I would say none of them are true because the name of the company was Adonis. And now it's all of a sudden Adidas. But okay, whatever. I think when they originally wrote the problem, they put Adidas and then they thought, oh, we can't use Adidas in this question. And they changed the question to Adonis but left the choices as Adidas. Okay? But what happened? Adidas must pay what? 200,000 at maturity plus what? 20 interest payments of 8,000 each, which is going to be what? The 200,000 times the what? Times the 8% times 1/2. Right? Okay, good. Do you have number 12? Okay, a company received cash proceeds of 206,948 on a bond with a par value of 200,000. The difference needs to go to premium. Let's just do the full journal entry. How much cash proceeds did they get? So what do you want me to do with that? Debit cash, good for what? 206,948. Okay, good. Then what? You want me to credit bond payable, I guess? For the face, always and forever, 200,000. So do I need a credit or a debit to make this journal entry balance? Credit for 6,948, and that credit is to what? I already have a credit to bond payable for 200,000. This is now the premium, right? 6,948. So there's a credit to premium on bond payable. Okay. Okay, good. How about, do you have number 13? Okay, good. Let's look at this one. Bond's par value is 100,000, and it was a 7% bond. Market rate was 6.5. So of course this bond's going to issue at a premium, isn't it? Okay. And how much am I going to pay the guy back? Even though he gives me 102,000, I'm going to pay him back the 100,000. So that what? That extra 2,105 that I'm going to get to keep is doing what? Making my interest expense less, isn't it? Okay, so they go ahead and they ask me what is the interest expense. So now since it's a premium, I do what? Let's figure out the premium. I take the 102, 105 minus what? Minus the 100,000 face. That gives me 2,105. I'm going to go ahead and divide that by how many periods? It is a 5-year bond. 5-year bond, so we need 10 periods, right? Okay, so I get what? Just, I'm going to peek at the solution here. 210.50 is the amount of premium amortization every semi-annual period. Okay, what's my buddy's name in this question? 100,000 times what? Times 7% divided by, or multiplied times 1/2, however we want to do that. What's that, 3,500? 3,500 minus now, right? Premium amortization reduces my interest expense, right? So 3,500 minus 210.50 gives me, I'm assuming this 3,289.50. Okay. Does your file go all the way up to questions number 20? Okay, so I'll put this file up for you, but it's more and more of the same, guys. Okay, so this is what you do. Well, you want to do the rest of them? Okay, so here's what you do. You go ahead and you stuff the turkey with these additional ones when I put them up there. And you need to sit there and you need to work with this over the break. Accounting is one of those things that if you don't use it, you lose it, right? And I promise you may sit here and say, oh, okay, I got this right now. If you don't practice with this, it's just like weightlifting. You're going to sit there and you're going to be like, geez, it was so light the other day. Now my arm wants to fall off when I try and do this. What's going on? So you need to sit there and you need to do what? You need to work back through these again and again, right? Particularly.
One with answers and one without, like we did on the past ones. That's been a big help.
Well, you can delete the answers. You're big boys and girls. I don't want to have to go through and delete the answers for you. Just go in. It's a Word file. Just go in and delete the answers. Or you can print it and just cover the answers. Oh, I see what you mean. With the answers are underlined, though, right? But you know the way I recommend you work these questions is don't have the multiple choice choices down there. The multiple choice choices don't help you. They help me. Why do they help me? Because now I don't have to sit there and correct, 20 papers and say, okay, did they write 926,395? Did they write 926,395? I don't have to sit there and do that. I just run it through a Scantron machine. It says, no, they didn't. And I know whether or not you did okay on it. So you don't need those multiple choice. So just cover it, right? Print it, cover it, and do the work as though there were no choices there.
During the break, what break? Thanksgiving break?
Starting Thursday.
Yeah, during Thanksgiving
Oh,
break.
you mean like because we still have class next Tuesday, right?
Yes,
Yes.
we have class on Tuesday, but some people have other classes that they don't have to go to next week.
Oh.
I mean, the rest of this week, excuse me.
So actually, if the answers are underlined or bold, you can just highlight the whole thing and click the bold and underline, and it'll clear itself out.
Yeah,
Does that help?
yeah. You just go to the thing that you don't want underlined anymore. Well, it's a little bit more complicated than that because they underline it and they bold it. So the way I do it is I go through, if you want to do that, and let's see. No, because that doesn't work either. What I do is I go over to that. Where's that stupid little paintbrush? There it is. I go over here and I paint what I want it to look like. Now it's going to fight with me because I'm trying to show you how to do it. So I want it to look like E, don't I? So I paint E. And then I come over. See why I don't want to have to do it? Okay. Yeah. But a good way to do it is to sit there and, like I just said, use that little paintbrush. So you do this. You paint it like that. Ah, God. Don't say it, John. Don't say it. Okay, so I painted that and then I come down. Okay, I have no idea why it's not working. Anyway, you can do it. You paint the thing that you want it to turn to. And I know it works because I've done it 10 frickin' million times. And then you go down to the one that you want to change and you brush over that and it will change it to the other one.
If you just control all and then highlight all of them and then underline all of them and then ununderline all of them, then it'll just not show you the answers then so that you can work on them.
Then it will show the answer as bolded.
And then you unbold.
You bold and unbold.
I don't think so, because I would have figured that out by now. For some reason, it never works. So you want to underline everything, and then un-underline everything, and then bold everything, and then what? And it still shows the answer bolded. Trust me. See, that's still bolded. And so is that. If it worked that way, I would have done that a long time ago. I got to sit there and paint every one of them. Yeah, I know. That's what I'm saying. Guys, figure it out. I'm done. Okay, I don't know. I'm telling you right now, it doesn't work. I've sat there for hours with these things, trying to turn a answer key into a test. And you got to do it that way. You got to do it one at a time. Okay. All right. So I'm going to close this. And I am going to stop this.